been a pretty wild market as we've seen all-time highs. There's been a lot of rotations within rotations, and today, rotating back from yesterday's rotation, let's try and zoom out and figure out what's going on. Willie Delwiche is joining us, investment strategist at All Star Charts. Willie, welcome back to the show. Let's start by talking market breadth, the kind of way to zoom out from all of the rotations and then the reversals of those. Overall, what does it look like right now in terms of how many stocks are participating in the rally? We might have lost Willie there. No, we got him. Okay, Willie, let's try again.
Oh,
we got you. What does the breadth look like right now?
Okay. Yeah, so the breadth from my perspective is we're still in a long-term uptrend. We've got some noise. We've had some consolidation. I think one of your previous guests mentioned that. But if you step back, this still looks like a cyclical rally that has broad, healthy participation beneath the surface. Maybe we got ahead of ourselves a little bit, but there are a lot of areas of the market that are in uptrends. If you look at it from a sector perspective, look at it from an industry group perspective, look at it from a global perspective, most areas of the world are moving higher. Most areas of the U.S. market are moving higher.
One of the things I noticed, Willie, was, let's go to yours first here. This is the market breadth according to a sector level trend indicator in the blue that is elevated, but below where we were earlier in the year a little bit. What does this tell you? What is this sector level trend indicator?
Yeah, so this looks at sector level trends from a price, momentum, and breadth perspective. So if you actually look at the detail of this right now, it's kind of interesting. Sector level price trends, really, really strong. Sector level momentum trends are not quite as strong. Sector level breadth trends are starting to struggle a little bit. So we really want to see this continue to improve to kind of give us that all clear signal that maybe the next leg of the cyclical rally is getting ready to emerge. If we don't see that, then I think kind of this period we've been in of a bit more choppiness, that likely lasts for a while.
One of the things that I noticed is looking at the new 52-week highs. They're pretty slim right now for an all-time record, at least was my conclusion when I looked at the chart, just kind of looking at the NASDAQ, really any of them, the broader Russell. They've trended lower over the last couple of weeks. And we had the big breakout for the S&P 500 past 4,000. We saw a little bit more participation. And then back when we got the vaccine-driven breakout in November was really a powerfully broad rally where a bunch of companies were making 52-week highs. What does that mean if our overall kind of breadth is fair and strong, but the number of companies at records has slipped?
Yeah, that's a great question. And that's something I'm seeing as well, that you go back to November, even as recently as March, you had more stocks joining the S&P and making new highs. What did we see yesterday? It was fewer individual stocks making new highs than the day before on the NYSE and on the NASDAQ. We don't want to overreact to that. A lack of new highs isn't in and of itself a divergence. It's maybe a lack of confirmation. But we do eventually want to see that confirmation emerge. And while we're not seeing it, and this is interesting, we're not seeing it domestically, over the last week, we have seen a number of international markets start to make new highs again. So if we can get some of that rotation, so not just the U.S. doing well and the U.S. index is doing well, but international markets start to make new highs again, then maybe some of the short-term noise from a kind of slim new high list U.S. in the U.S. probably doesn't matter as much.
Okay. Willie, if we look at what's happening in options, you track the put-call ratio. I think this is a super interesting one, given that it was very depressed for a long time, given we had so much call buying. We've seen the data showing some of that far out of the money, the YOLO speculating in calls has faded somewhat. We can see that in just options data. We can see in VIX, the way VIX has dropped too. But that put-call ratio is going back down again, it seems like.
Yeah, it is. It's not as low as it was earlier in the year, but it is starting to drop. We had a reading last week from an equity perspective of put call ratio in the 30s. That's very deeply seated complacency. And that really confirms what we're seeing in some of the other sentiment data, that this latest move higher in terms of the S&P 500, while we're not seeing it in terms of individual stock participation, investors are getting giddy, whether you're looking at options traders or some of the weekly investment surveys. There is widespread optimism that is starting to accompany this latest move to new highs.
Now, that optimism coming back, it doesn't seem like it's a coincidence that when the NASDAQ takes part, our put-call ratio starts going lower. What type of ability does this have to tell us kind of what's coming or give us comparables? I mean, one of the things we saw earlier this year was the time that that put-call ratio was spending at very depressed levels was really only comparable to a few times in history, one of them being .com and the kind of analogous period of froth. So what type of indication does it tell you? I mean, can we have another big tech melt-up like we got in February?
Yeah, I think that's possible. I think it's important when we talk about sentiment generally to remember that investor sentiment behaves differently when we're talking about lows than when we're talking about highs. Fear, spikes in the put-call ratio, super high levels of bearish readings in the sentiment surveys. Those spike and then they quickly ebb. When you talk about optimism, whether it's the low put-call ratios or some of the other sentiment surveys, optimism can stay high for extended periods of time. And so, I've been talking a lot about some of these readings are the highest levels since early 2018 in terms of some of the bull-bear spreads. But we anchor to that, but then we look at 2017 and those readings were high for almost that entire year. And 2017 was a year of great broad strength in the equity market with virtually no drawdown. So we don't want to say, okay, well, we're seeing excessive optimism. The end is today. What it does say is pay a little more attention now that optimism is back to excessive levels.
So we heard a little bit of a similar message from Tony Dwyer at the top of the show that some of the kind of overextended metrics he looks at suggest the market is due for a little bit of a pause or pull back, and that the sentiment too is getting quite elevated. Of course, there's a lot of different ways to look at this. You've got a few as well in terms of the sentiment spread. I think is an interesting one. The individual investors versus advisory services. Walk me through what that means when it gets as low as it is today, which I guess would mean individual investors are far more optimistic than the money managers.
Well, so we talk about excessive optimism, and then we look at the spread between where the advisory services are and individuals are, and they're basically, on top of each other. So the spread is near zero. That actually happens closer to market lows than to market peaks. So that's kind of the contrary indicator is that spread. So advisory services sentiment very high, AAI survey sentiment very high, but the two aren't out of whack to each other. And so frankly, I'd be more concerned if we had sentiment advisory services were still very high, and then individual sentiment was starting to back off some. But while they're both high, it takes bulls to make a bull market. Maybe that's some of what we're seeing right now.
So it seems like the sentiment data at this moment is fairly mixed. If maybe a little bit of a bias is being more favorable for the market based on a few of these charts. As you mentioned, the idea here that folks are kind of in line, advisory services and individuals. Obviously, you got to have people wanting to buy stocks for stocks to go up. So the kind of contrarian nature, it has to be to very extremes, does it not? When we kind of want to use optimistic things as a reverse and reverse indicator, they probably need to be more elevated than they are right now.
There's probably some room for further elevation. But I think what we have seen is enough of a move in terms of optimism to say the risks are increasing. Is sentiment alone going to upset the apple cart? Probably not. But given where investors are positioned, given where expectations for earnings and the economy are, it wouldn't take much of a hiccup. It wouldn't take much of a route for the wagon to stumble over before things could kind of fall apart a bit. I think that's the way I'm thinking about it.
Okay. Hey, Willie, the other thing that's so important, right, is that the market has been so divided that these kind of broad measurements maybe are not the best ways to capture this either-or market. As you mentioned, you know, it seems like your view is that the cyclical rotation is still generally the way to think about things. So that's where I kind of want to leave this segment, is what to you is the most compelling evidence of that thus far? Because maybe these kind of far out top line sentiment gauges are not showing us the real kind of turmoil on a rotationary basis that's been going both ways the last couple months.
Yeah, that's a great point. We look at market aggregates and they, because they're useful, but they miss a lot of the noise that happens beneath the surface. And I think that's where the really interesting rotation is right now. So we talk about strong breadth, for example, in the market overall, but you look over at the NASDAQ and, you know, even as the NASDAQ 100 is making new all-time highs, you got 60% of the stocks on the NASDAQ composite that aren't even above their 50-day moving averages. And so there's weakness there, but then you go over to some of the cyclical areas, financials, industrials, energy, materials. They're the beneficiaries to some of the macro forces that we're seeing in terms of a turn higher in terms of growth, some upward pressure in inflation, a move higher in yields even. So if we just try to boil it down to one indicator, we miss a lot, and I think that's where that's where the really interesting developments are right now, is some of that rotation away from what we saw over the past decade towards perhaps what we might see over the coming decade, which is more cyclical-led growth than I think we've seen.
Okay. Willie, thanks as always for the walkthrough here. Appreciate the detailed sentiment and breadth charts. Willie Delwiche joining us from All-Star Charts, investment strategist, and looking at the cyclical trend as perhaps still having some legs here. And sentiment, not overboiled to a point that it was at in February is my conclusion from there.